In this presentation on the economy, I thought I'd talk about three main issues. So I thought I'd start a bit about talking a little bit about Brexit and the issues around that. Then I'd follow that with some information about the economic outlook, focusing on next year in particular. And then I'd wrap up just by focusing on some of the bigger picture issues in the global economy, so that we're not just overly focused on what's happening in the UK. So first of all, in terms of Brexit, I thought a good point to start would be just to take a step back and to think about all the uncertainties and all the things that we don't know that have emerged as a result of the referendum result to leave the European Union. And this is a list that we drew up in our team back in June, just noting down what we didn't know and expecting to be able to cross those things off at various points in time. So I think it's fair to say that uncertainty still dominates the landscape, the economic and the political landscape. The first two are pretty obvious. And then last week we also got from the Chancellor of the Exchequer in the autumn statement some more clarity around fiscal policy, some more clarity around the path for taxation and public spending. But overall, what we don't know as a result of the vote to leave the EU still outweighs what we don't know, what we do know. Perhaps most important of all, most immediate, concerns the timing when we'll trigger Article 50. We obviously thought we knew more about that, and then the waters were somewhat muddied in recent weeks. Another big issue, of course, relates to the sort of constitutional situation, most prominently perhaps in terms of Scotland. Will there be another Scottish referendum on independence as a result of the Scottish vote to remain? Will there be another general election? It must be an early general election. It must be a sort of temptation for the Prime Minister, given the relatively small majority and the lead that she has in the polls at the moment. Beyond that, we don't know also what collateral damage it's going to have on the rest of the European Union. So will it fuel more populist movements in the rest of the EU? Will it change the balance of power in the European Union? How is that going to influence how the European Union engages with the UK in the negotiating process? And finally, we of course don't know what kind of trade deal the UK is likely to get with the European Union as a result of exit. So, as I mentioned, we've got a number of areas of uncertainty, and we can really think about the referendum result as imparting two main shocks on the economy, one in the form of uncertainty and one that's more structural in nature. So uncertainty, as we know, spiked very sharply following the referendum result back in June, and since then it has receded somewhat. But I think it's important to recognise that measures of uncertainty around the outlook and around economic policy still remain very elevated on our historical standards. So at the moment, they're about in line with where they were a few years ago when the Eurozone crisis was at its peak. And the other shock to the economy is more structural in nature, and that concerns our trading relationships and how we're going to be able to trade with the rest of the world in the years ahead. As is well known, about 50% of our exports go to the European Union, but beyond that, about another quarter are also influenced by our membership of the EU. So the European Union has free trade agreements that are in force or impending with a number of countries, and we obviously benefit from that as a result of EU membership. So over 3/4 of our trade is influenced by EU membership to one extent or another. And all of that's in a state of flux. It's no surprise that as a result of that, uncertainty is high, and that's had an impact on business confidence. I just want to focus a little bit on the outlook for trade. Obviously, that's going to impact different sectors in different ways. If we leave the European Union without a transitional process in place to maintain the sort of trading relationships that we have at present for an interim period, or if we leave the European Union without having negotiated a trade agreement in the sort of 2-year process in which the Article 50 negotiations take place, then we'll default to World Trade Organization rules with the EU as a result. And that means that the European Union will be able to put tariffs on what we export to them. How significant would that be? Well, on the positive side, that the largest tariffs would likely hit those sectors which are relatively insignificant on an individual basis. They don't account for a particularly large share of our exports. Probably more notable in terms of our export base are things like electrical machinery, petroleum, chemicals, transport equipment, within that cars, of course. And those would typically face tariffs about 3 to 4%. Within that, cars would be somewhat more significant at about 10%. Beyond that, however, it's important to recognise that there are other costs associated with trying to export goods and services across international borders, not just captured in terms of tariffs, but also non-tariff barriers. So differences in terms of regulatory standards, around product regulations, health and safety, different legal systems, all of which raise costs associated with moving goods and services across borders. And putting a cost on that is difficult. That's just one attempt at putting a cost on it from PwC. But overall, the message is we're moving into a period in which we're going to have less open trading relationships with the European Union, and that's going to raise export costs and import costs for British businesses. In terms of what the longer-term outlook is as a result of leaving the EU, what's the longer-term impact on the economy? Unsurprisingly, there's a wide range of estimates given the nature of the issue. One end of the spectrum, we have organisations like the Treasury, which see it as just overwhelmingly negative. The other end of the spectrum, we have sort of free market economists and think tanks, which have published reports suggesting there's more of a more positive consequences as a result of exiting the EU. What are the reasons for why there's this wide disagreement? We can probably boil this down into sort of three main issues. And it's the extent to which people disagree around just how easy it will be for us to access the single market on terms that are basically as easy as they are at present. And to what extent we will impose immigration controls as a result of exiting the EU. I think it's fair to say that given the sort of tone of the message coming from the other European Union governments, they wouldn't be happy with a situation where we're going to have access to the single market on terms similar to those at present, and also be able to control immigration in a way that we can't at present. So the combination of those two things suggests that longer-term consequences of leaving the EU at the moment are skewed towards the left-hand side of that chart. So that's the situation in terms of Brexit. Moving on now and just focusing a bit more on the economic outlook. I think in terms of making an assessment of what economic prospects are, an important part of that is always just to take a step back and make an assessment of what the economy looks like at present. Think about other vulnerabilities in the economy, sort of excesses or imbalances that give cause for concern. Overall, I think it's fair to say that when you look across a range of measures, economic fundamentals provide some limited reassurance at the present time. So if you look at, for example, the situation in the housing market, which in this country obviously is always a major driver of where we are in the economic cycle, housing market isn't particularly overheated, at least outside of London. We don't see property transactions as being particularly high. Mortgage payments aren't placing a particular burden on household finances at present. And also, in recent years, firms and households have acted in a pretty conservative manner in the post-financial crisis period, and they've been reducing debt levels. So that's decreased the vulnerability that businesses and households have in the face of the kind of shock that we've experienced following the referendum result. So overall, some limited reassurance provided by economic fundamentals. And that's probably been part of the reason why most recently, in the third quarter, economic growth held up pretty well and better than people were expecting immediately following the referendum result in June. So GDP growth slowed only very slightly in the third quarter, still continued to expand at a rate of 0.5%. So that's pretty much in line with the economy's long-run average rate of growth. So again, there were some positive signs there, some signs of reassurance. And business surveys for the fourth quarter, the early evidence that we have, suggests a similar pace has continued into the current quarter. And we see growth broadening a little bit more as well. So manufacturing, services, construction, firms in each of those sectors indicating that economic activity is expanding. But how much reassurance does that provide overall? I think one of the ways in which to look at that is also to break down GDP growth in terms of expenditure. So in terms of expenditure by households and expenditure by businesses. And how did that hold up in the third quarter? Well, business investment continued to grow in Q3. And that was also another positive sign. But that probably reflects the business decisions taken well in advance of the referendum, maybe 6, 9, 12 months in advance, that only came to fruition in the third quarter. So that probably only has limited relevance that the sort of positive news we saw in business investment in the third quarter probably only has limited relevance when looking ahead for economic prospects into next year. And indeed, we've seen in terms of business surveys that investment intentions have weakened quite substantially through the second half of the year. So businesses are saying they feel the economic climate is more uncertain, particularly around demand, and they're signalling that as a constraint around investment intentions in particular. So that suggests to us that business investment is likely to slow next year from the rates that we've seen this year. It's important to bear in mind as well that business investment is only 10% of the economy. So obviously that's influenced heavily by wider trends in the economic environment. And the main driver of the pace of economic growth is really household consumption, because that accounts for 60% of the economy. So it's worth taking a look briefly at what conditions are like for the household sector. Overall, at the present time, households also say that they're feeling pretty good, even in spite of the referendum. They see that now is still a good time to make major purchases like cars and household appliances. And perhaps that's not too surprising overall when we think that unemployment is very low. It's below 5% now. And households also, for a couple of years now, they've been seeing real growth in their real disposable income. So although wage growth overall remains pretty moderate at about 2%, inflation, of course, has been very low over the last couple of years. So that combination has meant that in real terms, wages have been increasing. And that probably explains why households continue to feel pretty upbeat about the outlook for their own personal finances. Where the clouds have gathered somewhat is in terms of what households say about the outlook for the economy. They have become a bit more pessimistic about that, probably reflects the news flow around what we're hearing about the economic outlook. Where households aren't making the connection at the moment is in terms of the greater pessimism they see for the economy. They're not necessarily translating that over into their own personal finances. So we think that households are kind of underestimating the challenges that are going to emerge in 2017, in particular the rise in inflation that we're likely to see. So back in June, sterling fell very sharply following the referendum result. It's fallen further since. The consequence of that, obviously, is to push up on import prices. That feeds through into inflation. We're likely to see inflation rise from the current rate of about 1% at the moment to reaching 2% and then exceeding that in the first half of next year. The consequence of that is it's going to put pressure on household budgets, and overall it doesn't seem from survey measures that households fully appreciate the squeeze on finances that are going to emerge. So we think that's going to be a major factor, along with slower business investment, slowing the pace of economic growth through 2017. So what does that mean for lending and borrowing in the economy? I think, first of all, it's important to recognise that growth in unsecured lending has been pretty strong over the last couple of years. We've seen that in terms of credit cards. We've seen it also in terms of asset financing. And in the media, that's given rise to sort of speculation about excessive behaviour and a return to the bad old ways of the British economy. But for us, it's, what we also try to keep in mind is what happened in the years following the financial crisis. Well, households became more conservative in their behaviour. They reduced their levels of indebtedness. And overall, unsecured balances in the economy fell about 20% during that period. So what we're seeing in terms of growth, in strong rates of growth in unsecured lending is in our view more a return to more normal trends that we would typically see in the economy. So there are two factors we think that are going to sort of pull in opposite directions next year. One is that relatively reassuring situation where households have reduced debt levels, and also where mortgage payments are placing less of a burden on household finances, and that's freed up more room for households to take on unsecured credit and to service that unsecured credit without it placing a particular stress on their family budgets. On the other hand, though, we're going to see, as I mentioned, a weaker economic environment where growth is likely to slow. Household finances are going to come under more pressure from higher inflation, and it's probably likely that as GDP growth slows, unemployment will tick higher as well. So there are two factors that are going to pull in opposite directions. But in our view, it doesn't mean that the outlook for lending is overly pessimistic. We tend to see it as more of a moderation of these strong rates of growth that we have seen over the last couple of years. And when we look also at businesses, we tend to see a similar picture. Conservative behaviour of recent years has created a fairly supportive backdrop. given the economic shock that we've seen from the referendum. What does this mean for interest rates as well? If we're going to see a period of slower economic growth on the one hand and higher inflation on the other. Well, back in November, the Monetary Policy Committee, as we know, decided to keep interest rates on hold. And that was as a result of economic growth since the referendum proving a bit stronger than they had expected, and also the profile for inflation looking stronger than they had previously expected, given the additional fall in sterling. So what they said was inflation is going to exceed the target, but they're prepared to tolerate that in order to support economic activity and to support employment. So they're saying inflation is going to exceed the 2% target for a persistent period of time. A tolerance, however, isn't necessarily completely unlimited. What would perhaps test that tolerance of keeping rates on hold is that if that higher inflation started to feed through into wage growth, started to feed through into people's expectations of inflation, that might be a factor that would spur the Bank of England to tighten monetary policy to clamp down on that. We think it's unlikely that we're going to see that feeding through into wage growth given the wider economic environment. If growth is slowing and unemployment is ticking higher, it's not an environment in which we typically associate with stronger wage growth. So for us, the most likely path for interest rates next year, though there's uncertainties and risks around that, most likely path in our view is that interest rates remain on hold. And of course, at November's autumn statement a couple of weeks ago or so, Chancellor set out the stance of fiscal policy. For us, there weren't any major surprises within that. There was nothing that really changed our view of the economic outlook significantly. Chancellor reaffirmed that deficit reduction would continue, albeit at a slightly slower pace. So pace of fiscal consolidation is going to bear down on economic growth to less of an extent than was previously the case under the previous Chancellor's plan, but it's still going to be a drag on growth overall. As I mentioned, we saw sterling, of course, fall very sharply in the immediate post-referendum period. So the question really is, well, where is sterling likely to go over the period ahead? And we think that the level of sterling is very difficult to forecast at any point in time. It's even more difficult given the uncertainty that has emerged in recent months. But we think a useful way of thinking about it is that sterling is probably likely to be very sensitive to the perceived likelihood of a hard Brexit scenario unfolding. And we saw that back in October when the Prime Minister announced that Article 50 would be triggered by the end of March, that sterling took another leg down of about 4 or 5% when that announcement was made. So it does suggest, and then subsequently, as the High Court challenge was ruled in against the government, sterling rose somewhat in response to that. It does suggest that the level of sterling is going to be sensitive to the perceived likelihood of a hard Brexit scenario unfolding. Given the uncertainty around that at the moment, it suggests it's a very difficult thing to sort of place a forecast for sterling at the current point in time. In terms of oil, outlook for oil prices, oil future contracts suggest higher prices next year. The IMF, as their baseline forecast, have a figure of about $50 a barrel. And yesterday's announcement from OPEC is another factor that's only going to increase oil prices through next year, given the sort of reductions in supply that they intend. That those higher oil prices are another factor that are going to push up on inflationary pressures. And that's another factor that will act as an additional squeeze on household spending power. What about the international outlook beyond just the situation in the UK? Well, in terms of the Eurozone and the US, it's pretty moderate paces of growth that are forecast by organisations like the IMF. What has changed since they put out their forecast is the presidential victory by Donald Trump. The question is, well, to what extent does that change the outlook for the United States? It's difficult to tell just how committed the new president will be to the campaign promises he made, just the extent to which he's going to follow through on them. If we take them at his word, what they would imply, according to these estimates made by economists in the US, is that it represents a moderate boost in the near term to economic growth in terms of his plans to lower taxes and his plans to increase infrastructure spending. But over a longer-term horizon, his plans look like a negative for the US economy in terms of his plans to make trading relationships less open, flows of migration less open, and also its fiscal plans imply a sharp increase in indebtedness in the US economy. All of those things together would suggest negatives for longer-term economic prospects for the United States. So that's the situation in terms of the economic outlook. I just want to mention briefly some bigger picture issues so that we kind of remember there's a whole world just beyond Brexit in the UK. And two of those big picture issues one of them relates to levels of indebtedness in the global economy. So I mentioned that in recent years, households and businesses have reduced their levels of indebtedness, behaved in a more cautious and conservative fashion. But overall, when you look across the globe, levels of debt are higher than they were in the period that preceded the financial crisis. And to some extent, that's a consequence of governments running budget deficits to support economic growth in countries like the US and the UK and in the Eurozone. But another major factor that has raised levels of debt across the planet has been the reaction of China. So in the period immediately following the financial crisis, China loosened credit conditions significantly, and that led to quite an explosion of indebtedness in the Chinese economy. And that's raised concerns around what that means, because if you look across historical episodes, you can see a sort of similar pattern has emerged over time. So if you look at the situation in the UK and in the US and in Ireland leading up to the financial crisis, you can see a sort of when levels of debt rise as sharply as they have done in China, historically that has preceded a financial crisis. So the question arises is this likely to unfold in China as well? It does seem like the path that the Chinese economy is on in terms of the levels of indebtedness is ultimately unsustainable. And the challenge that policymakers in that economy have is sort of effecting a soft landing for the Chinese economy, with reining in levels of indebtedness and tightening up in credit conditions without effecting a hard landing that has wider economic consequences. It's a very difficult process to manage. You can sort of question the ability of Chinese policymakers to bring about that smooth landing. What would the consequences be if a financial crisis erupted in China? Well, arguably the Chinese state has control over resources in a way that we don't have in Western economies, so potential to bail out and sort of mop up the consequences of financial crisis. But if financial conditions continue on the trajectory that they have been for recent years, potentially the situation becomes so large that it overwhelms the ability of the state to bring about that bailout. What would the consequences be for the UK if we saw that kind of financial crisis? Well, we don't have particularly strong direct trade relationships with China at the moment, or financial linkages. The main exposure to the UK would be what it means for the global economy. So China has been the major driver of global growth in the years since the financial crisis. Economies that we are well connected to, like the Eurozone, have a greater exposure to China. So it would be a sort of second-round effect for the UK if the Chinese economy erupted in a financial crisis. When analysts think about the potential for a financial crisis in China, they're thinking maybe 5 years ahead rather than an immediate thing. But it's an important risk around the global economic outlook. And finally, the other major question in the global economy is, to what extent are the weak, sort of sluggish, subdued rates of growth that we've seen since the financial crisis just a permanent feature or a very persistent feature of economic growth? Is this now the new normal? And there are two main factors that economists point to substantiate that. One of them relates to demographics and the other relates to productivity. So the two factors that are the long-run determinants of economic growth. In terms of demographics, what we're now entering in the next 5 years is a very sort of different period, because we're going to see across the globe that growth in working age population is going to turn negative in a number of economies. We're going to see that in advanced economies, not the UK or the US, but we're going to see it in Japan and in Germany. We're going to see it in new advanced economies in Central and Eastern Europe. And also prominently, we're going to see it in China as well. So this is going to be quite a marked shift from what we've seen over the last couple of decades, where there was strong growth in working age population, and that helped to drive GDP growth overall. And the other factor that has contributed to the weak rates of growth across the globe since the financial crisis relates to productivity. Some of that relates, and the reason why productivity is important is because it's the long-run driver of higher living standards. There are a couple of reasons why productivity may have slowed. One of them perhaps relates to the financial crisis. Perhaps it's the case that credit isn't being allocated particularly well to sort of new, younger startup companies where the scope to make productivity gains is greater. Maybe it's also the case that low interest rates have helped to keep firms in business that don't have a long-term future, so that there's capital and there's labour tied up in companies that could more efficiently be used elsewhere if we were in a higher interest rate environment. Perhaps it's also the case that the gains from the digital economy are waning in terms of productivity growth. Perhaps it's also the case that we're very bad at measuring economic output in terms of the digital economy. It's a real challenge for the people who collect those statistics. It's maybe not something that we're not particularly good at. Maybe actually economic growth is faster than the headline figures would suggest. It's a sort of typical economist answer that it's a very important economic issue. It's one that's not particularly well understood at the present time. We can only put forward suggestions to explain why productivity growth might remain at lower rates than we have typically has typically been the case in recent decades. But the reason why it's important is that it's the long-run driver of living standards. And if productivity growth remains low, it would suggest also that we would remain in a low interest rate environment for a prolonged period of time. There wouldn't be as much of a necessity for central banks to increase interest rates as sharply or as fast as we might project at the present time. So just in terms of summarising the economic outlook, as I said, economic growth has been resilient since the referendum, provides some reassurance, but only to a limited extent, because we think the economy is going to enter a slower growth phase next year as a result of higher inflation and as a result of uncertainty bearing down on business investment. The key point from the Bank of England is they're willing to tolerate higher inflation, but that tolerance isn't necessarily unlimited. And in the United States, we've seen Donald Trump's victory a positive for short-term growth prospects in the United States, but arguably storing up longer-term prospects further down the road.